In February 2026, the United States pulled off something it had never done before. 54 countries, almost the entire Western world, plus key partners across Asia, Africa, and Latin America, sent their ministers to Washington for one single purpose: to break the world's dependence on China for critical minerals. U.S. Vice President J.D. Vance stood on that stage and said something simple but striking. The global market for critical minerals is failing, and supply chains are brittle and exceptionally concentrated. His message was clear. Countries needed to start moving away from China together as a bloc. Argentina was in the room. Argentina signed on. And then, just 3 months later, Argentina's government approved a $1.24 billion investment led by a Chinese company to expand one of the most important lithium operations in South America. So what actually happened here? Did Argentina just walk back a commitment to its biggest ally? Or is there something deeper going on? Something that says a lot about how the entire global race for critical minerals is really being fought? Let's dig into it. To understand why this matters, we have to rewind a bit. For decades, oil was the resource that shaped global politics. Wars were fought over it, alliances were built around it, and entire economies rose and fell with its price. But over the last 15 years, a quieter resource race has been building: critical minerals. Around 2010, the world got its first real wake-up call. A diplomatic dispute between China and Japan led to disruptions in rare earth exports, and suddenly countries realized something uncomfortable. These minerals weren't just used in consumer electronics. They're essential for military hardware, semiconductors, wind turbines, and electric vehicles. If the supply gets cut off, entire industries can grind to a halt. Fast forward to today, and the stakes are even higher. The boom in electric vehicles, artificial intelligence, semiconductors, and renewable energy has made minerals like lithium, cobalt, copper, and rare earth elements absolutely central to the next phase of the global economy. According to analysts, whoever secures reliable access to these materials and the ability to process them will have a major advantage in the technology race of the coming decades. And on that front, China has built up an enormous head start. According to assessments from the International Energy Agency, China currently accounts for around 60% of global rare earth mining. But when it comes to processing and refining those minerals into usable materials, China's share jumps to roughly 90%. That second number is the one that worries Western governments the most, because even countries that can mine their own rare earths often still depend on Chinese facilities to actually turn that raw material into something usable. This concentration is exactly why the United States and its allies started building alternative networks. In 2022, the US launched the Mineral Security Partnership with countries including Australia, Japan, South Korea, and the European Union, a group that has since grown to around 14 members. In July 2025, the Quad, the US, Australia, India, and Japan, launched their own Critical Minerals Initiative. Around the same time, the G7 introduced a Critical Minerals Action Plan. All of this set the stage for that February 2026 meeting in Washington, the Critical Minerals Ministerial, where Vance pitched his most ambitious idea yet: price floors for key minerals like lithium and copper, and a trading bloc designed to give allied nations an edge over China. Argentina, sitting on one of the largest lithium reserves on the planet, was right there at the table. Here's what we know for certain, based on official statements and public records. On February 4, 2026, the U.S. State Department hosted the inaugural Critical Minerals Ministerial in Washington. Secretary of State Marco Rubio led the event, with Vice President Vance delivering the keynote. Delegations from 54 countries plus the European Commission attended, including Argentina. During the event, the U.S. signed bilateral critical minerals frameworks or memoranda of understanding with a dozen countries, Argentina among them. Vance publicly proposed establishing price floors for critical minerals and floated the idea of a preferential trading bloc among allied nations. Then, in May 2026, Argentina's government, under President Javier Milei, approved two major mining projects under its RIGI, Large Investment Incentive Regime. The first was a $1.24 billion lithium joint venture in Jujuy province, in the heart of South America's so-called Lithium Triangle, the border region shared by Argentina, Chile, and Bolivia, which holds some of the richest lithium brine deposits in the world. According to industry reporting, the largest shareholder in this joint venture is Ganfeng Lithium, a major Chinese lithium company, alongside the Nasdaq-listed Lithium Argentina AG and Jujuy's provincial state mining entity, JEMSE. The second was the PSG Cobre Mendocino project, formerly known as San Jorge, a roughly $891 million copper mining project in Mendoza province. This is notable because Mendoza is best known for wine and agriculture, and has historically been cautious about large-scale metal mining. According to Argentina's economy minister Luis Caputo, the two projects together are expected to generate more than 8,000 direct and indirect jobs. It's also worth noting that Argentina's RIGI framework offers approved large investments, significant long-term tax and regulatory stability guarantees, a feature designed specifically to reassure investors, regardless of where they're from, that the terms of their investment won't be unilaterally changed by future governments. On the lithium production side, Ganfeng's involvement in Argentina isn't new. The company has held a stake in the Cauchari-Olaroz lithium project, also in Jujuy, since around 2018 to 2019. According to company filings, lithium carbonate prices have been recovering through early 2026, with Cauchari-Olaroz selling at an average of roughly $16,800 per ton in the first quarter of the year, a meaningful improvement after a period of lower prices that had squeezed the industry. So why does this matter beyond Argentina? For Argentina, the math is fairly straightforward. The country sits on enormous lithium resources, but resources in the ground aren't the same as money in the bank. Turning brine into battery-grade lithium carbonate requires evaporation ponds, processing plants, purification technology, environmental management systems, and, critically, buyers. According to industry estimates, Argentina's current lithium output is still far below countries like Australia and Chile, despite having some of the largest reserves on the continent. And here's the uncomfortable truth for Western strategy. Even if Argentina mines more lithium, the world's largest battery manufacturing base, by a wide margin, is still in China. So no matter who invests in the mine, much of that lithium is likely to end up flowing toward Chinese processing and battery supply chains, simply because that's where the demand and infrastructure already exist. For China, deepening its position in the lithium triangle reinforces something it has been building for years: a steady upstream supply of the raw materials its battery and EV industries depend on, sourced through long-term partnerships rather than short-term purchases. And for the United States and its allies, this case is a reminder that de-risking supply chains isn't just about signing agreements and forming alliances. It also requires matching investment, processing capacity, and demand. And building all of that takes years, sometimes decades. In the meantime, countries like Argentina still need capital now, and they'll generally go where the capital and the buyers actually are. Analysts who study Argentina's foreign policy point out that this isn't really a contradiction. It's consistency with how Milei's government has approached economic policy more broadly. During his presidential campaign, Milei was famously critical of China's government, at times using harsh rhetoric about its political system. But since taking office, his administration has taken a more pragmatic approach toward Beijing, something many analysts attribute to Argentina's deep economic ties with China. China remains one of the largest buyers of Argentine agricultural exports, including soybeans and beef, and the Chinese central bank has maintained a currency swap arrangement with Argentina that has, at various points, helped Buenos Aires manage its foreign currency reserves during periods of economic stress. According to the IEA, The broader challenge facing Western efforts to diversify critical mineral supply chains is investment scale. The agency has estimated that roughly $60 billion in public and private investment is needed over the next decade just to build out non-Chinese rare earth processing and refining capacity to meet projected demand. Experts suggest that until similar levels of Western capital and demand actually materialize in places like Argentina, announcements and partnership frameworks may not be enough to compete with the immediate, large-scale capital that Chinese companies are willing to deploy. Some analysts frame what Argentina is doing as a form of multi-alignment, engaging with both the US-led mineral framework and Chinese investments simultaneously, rather than treating it as an exclusive choice between the two. Not everyone reads this story the same way, and it's worth laying out the different viewpoints. From the perspective of US officials and some Western analysts, this kind of deal, a major Chinese-led investment in a lithium triangle country, just months after that country signed a critical minerals framework with Washington, could be seen as a setback for the broader desinitization push, or at least evidence of how difficult that push will be to execute in practice. From Argentina's perspective, officials have generally framed their approach as pragmatic rather than oppositional. The RIGI framework was designed to be open to investors from any country, and Argentine officials have presented the February agreement with the US and the May approvals, involving Chinese capital, as complementary parts of a broader strategy to attract investment from wherever it's available, not as a rejection of either side. From a Chinese perspective, reflected in how Chinese state-linked media and officials typically describe such deals, these investments are usually framed as long-term, mutually beneficial economic partnerships, consistent with China's broader narrative around win-win cooperation with developing economies. And there's a more skeptical view, too, held by some independent analysts, that the long-term durability of either side's promises, whether that's a 30-year regulatory guarantee from Argentina or a US price floor mechanism that hasn't yet been fully implemented, remains untested, especially given Argentina's history of policy shifts under different governments. So where does this go from here? It's important to be clear. Nobody can say for certain how this plays out, but there are a few possible directions analysts are watching. One possible outcome is that other lithium triangle countries, particularly Chile and Bolivia, which also hold major lithium reserves, face similar pressures, balancing Western alliance frameworks against the practical reality of where capital and demand are coming from. Another possible scenario is that the US price floor proposal, if it's actually implemented, could shift the economics of projects like the ones in Jujuy over time, though how and when that might happen remains uncertain, since the mechanism was still being developed as of early to mid-2026. It's also possible that this becomes something of a case study, one that Western policymakers point to when assessing how effective ministerial agreements and partnership frameworks really are at changing investment flows on the ground, versus how much more direct financial commitment might be needed. What's clear is that the long-term impact of all of this, both on Argentina's economic development and on the broader US-China competition over critical minerals, remains uncertain and will likely depend on factors like global lithium prices, EV demand growth, and how both Washington and Beijing choose to compete for influence in resource-rich countries going forward. At first glance, this story might look like a simple plot twist. A country flips from one superpower to another within a matter of months. But the reality, based on what's actually been reported and confirmed, is more nuanced than that. Argentina didn't necessarily choose China over the United States. What it did was take a calculated bet that it could benefit from both, signing on to a Western-led framework while also opening the door to the capital and processing networks that, for now, only China can offer at this scale. And maybe that's the bigger story here. As the world's major powers compete for the materials that will power the next generation of technology, it's not always the countries with the most resources that hold the cards. It's the countries that can play multiple sides at once and extract value from each of them. Whether that strategy pays off for Argentina in the long run, and whether it forces the US and its allies to rethink how they compete for influence over critical minerals is something we'll only really know with time. This video is based on publicly available reports, official government statements, and expert commentary available as of mid-2026. Geopolitical and economic developments, especially in areas as fast-moving as critical minerals policy and international investment, can change quickly. Some details, figures, or project timelines discussed here may be updated or revised as new information emerges. Viewers are encouraged to follow trusted news sources for the latest developments on this topic.